Good morning, everyone, and thank you for joining us. I'm Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management, and it's my pleasure to welcome you to today's webinar, Beyond Big Tech. Now, as the title suggests, today we're looking beyond the small group of tech companies that have dominated headlines in market returns in recent years. We're going to be exploring what that means for diversification, portfolio construction, and client outcomes. Joining me this morning are two of Blackfinch's senior investment leaders. First, we'll hear from Mark Keogh, our head of asset management, who will discuss the growing shift we're seeing from off-the-shelf MPS solutions towards more tailored investment propositions and the framework we've developed to help firms navigate that transition. Following Mark is Gareth Deacon, our head of multi-asset, who'll explore the concentration risks that have quietly emerged within many portfolios and how advisors can use asset allocation and portfolio construction to build more resilient client outcomes. Now, if you have any questions during the session, please submit them through the Q&A function and we'll come back to them afterwards. And we'll also be running a live poll during today's session, so please have your cursors ready to take part when that appears. Now, for learning objectives, by the end of today's session, we hope you'll have a clear understanding of where concentration risks may exist within your current proposition and the practical steps that are available to improve diversification, governance, and client outcomes. Now, before we begin, I'd just like to give everyone a quick reminder that today's content is intended for financial professionals only, and so it shouldn't be considered financial advice. So with that, I'll now hand over to Mark to get us started. Good morning, Mark.
Good morning, Jordan, and good morning, everybody. Thank you very much for joining us this morning. I really hope you get good experience from today's session, and I'm looking forward to spending a bit of time with you this morning. So before I go into the main presentation, I just want to remind everyone a bit more about Blackfinch and our core values. With the ever-changing landscape and the continued demand on advisors with ongoing regulatory pressures, we think about the impact of changing markets and how we can help you adapt for those challenges. At Blackfinch, we are constantly looking for ways to evolve and innovate through product and solution-driven outcomes. This supports advisors and their clients to thrive and future-proof their businesses while creating relationships built on trust and support. I think it's really important for everybody to understand who we are, what we represent as a brand, and how we're trying to help support advisors and their clients adapt, evolve, and thrive with those ever-changing markets. So thinking about the main presentation, moving away from MPS to TPS and the introduction of the advisor playbook, looking at ways that IFAs are reviewing their current investment propositions, reassessing their solutions, and looking for ways to move forward with the ever-changing markets. I'd like to take this opportunity to give you a bit of background on our 8 Reasons to Review CIP project that we delivered last year. For those of you that heard myself, Gareth, and Jordan present in 2025, with the impact of the Section 165 report, I'm not going to go over that because that's sort of considered old news. What happened was we were approached by a number of firms that said, look, we're really concerned about our CIP and the fact that we're now under pressure to create a CRP, which is the retirement version of the investment proposition. We're struggling to understand if our investment proposition is fit for purpose. So we did some research in the market. We looked at ways that we could help support advisors, and we came up with the 8 reasons why to review your CIP. And this document was designed to give advisors a thought leadership piece, enabling them to understand how their CIP is currently structured, what are the areas that they are looking at to review that CIP and CRP, and looking for practical ways that they could implement changes within that process. And what that gave us was more information that enabled us to understand what advisors realized, that their business has evolved, but continues to need to evolve. Client expectations had changed. Some advisors said that clients were becoming more savvy, with the interjection of sort of AI and what's going on in the world. Clients were demanding more. The continued risks and pressures of consumer duty and strong governance was becoming more of a time-consuming process and administrative burden for IFAs, and all the complexities that sit with that from an operational perspective were areas that they needed to look at. So that led to a bigger question from advisors. This is us talking to advisors rather than us telling you. Advisors coming back to us and saying, right, like the CIP review, these are the areas that we've identified. These are the things that we need to think about. How can we take that forward? So what did actually come next? Well, what it meant was that advisors thinking about their current proposition, thinking about off-the-shelf MPS, and what they were currently using within their centralized investment proposition and or retirement proposition. What are the key decision-making processes that advisors felt were important for them to understand how they could look at what they were currently offering their client bank and thinking about what they wanted going forward. So this wasn't about replacing investment expertise. It was about creating a proposition that better fitted the firm in today's ever-changing markets and supported their clients. And these are some of the key areas that advisors brought to our attention they wanted to look at. So thinking about control. This isn't an advisor firm taking over discretionary fund management. It's about the advisor firm having the ability to be able to input into what their proposition looks and feels like relative to the journey the clients are going on. Advisors wanted to have a closer relationship with the underlying investment partner. They wanted to not have the need to go into the complexities of truly understanding the investment process that fund managers use, but having a strong aligned philosophy that fitted both with their philosophy as well as the underlying investment partner. They wanted support and help on guidance on strong governance visibility. They were concerned about the type and styles of communications that were being sent out to their clients. They wanted to be able to understand what their clients wanted to receive and make sure that the communication that they're sending out is in line with what the clients are expecting, or at least having an input into how the communication's sent. So many times I've spoken to advisors that say to me, they either get too much or not enough. There doesn't seem to be a happy medium. They're either downloaded with umpteen emails on a daily basis. It's not client specific. It's more generic. It doesn't fit in line with what they're trying to achieve, and it actually ends up creating more work for them. Thinking about operational flexibility, they want that flexibility. They want to be able to find ways to create efficiencies within their operational functions. And they want to make sure that the administration burden that they're under is controlled and gives them back the opportunity to spend more time with their clients. And last but not least, evidence and value. This was about making sure that the advice firms truly understand the value that they're creating and making sure that the value they're getting from the investment proposition is in line with what they're trying to achieve with their own advice process and the value they're trying to give their clients. So thinking about MPS, can I make it absolutely clear? I'm not trying to suggest that MPS is a solution that is not fit for market. As everybody knows, if you don't know, there's now over 250 different MPS providers in the market. I would argue this market is now highly saturated, over commoditized, but it is projected to drive AUM by another 200 billion over the next 3 years, already reaching a 300 billion pound market currently. So anyone who's outsourcing and using MPS structure, you know the value. However, how do you choose the right provider? One of the areas that has been identified from the tailored proposition is that MPS has become a bit commoditized and a bit sort of me too. The models are generic. They're driven by the provider rather than the advisor. The flexibility built into the investment capabilities is restricted. Communication is, fact sheet, maybe a quarterly report, but no thought leadership, not enough information, not enough client-facing material that enables the advisor to act quickly to the market movements and changes and volatility, but keeps them in a place where the client feels that they're being kept informed of what's going on in the world. They feel that governance has become a little bit washy, and they feel stuck in the same framework. There isn't the flexibility to be able to move as their clients' investment requirements change, or they need the flexibility to move that framework around. So we believe the future is through tailored portfolio services. Why do I believe that? Well, it gives the advisor the opportunity or the firm to create a range of portfolios that enables them to be able to meet the continued ongoing pressures from a regulatory perspective. It gives them the opportunity to brand the experience that the client's going to receive, gives you the opportunity to work with the investment provider in a collaborative structure, enabling you to be able to, or for us to understand the relationship that you're trying to achieve with you and your clients, and looking for ways to build a range of models that represent that collaborative structure. It gives you the ability to customize the proposition, and it also allows you to be involved in the oversight. Again, I want to make it absolutely clear. A tailored portfolio service is not a full bespoke discretionary service. The reason I'm mentioning it is we have had a number of clients that have said to us, oh my God, so I need to have full responsibility. I need to make decisions. I need to deal with oversight in a asset allocation, full investment decision making process. No, you don't. Ultimately, in this proposition, we as the provider of this service take full responsibility for all of the investment decisions. It just means that you have an opportunity to have more control and more input where you want it. It also allows you to have the capability to change and adapt with those market conditions and create portfolios in line with what you're trying to achieve now and for the future. Really, truly believe that MPS is not dead, but for advice firms that want to be able to create that control, tailored portfolios are the way forward. So what are firms looking to change? So thinking about what a tailored portfolio service offers you, the areas that advisors came back to us and said, okay, Mark, fine, I hear what you're saying. I like the idea of a TPS, but these are, I wanted to understand what are the areas that are most important to the advisor to make sure that if a tailored service is going to meet what the advisor is looking for, what really adds value to the advice firm. And those are some of the key areas that came through from advisors. They wanted to have that control back. I mentioned when we did the 2025 8 Reasons Why to Review Your CIP, I sat down with Heather Watkins from Next Wealth Generation, and I asked Heather what over the next 18 months, what are the two most important areas that advisors are going to focus on? And she said control and CRP. We all know that the regulations move forward regarding investment proposition and retirement propositions, and this has come forward on the basis of what her and I talked about 16, 17 months ago. So advisors want the control. They want to create a better experience for their clients. They want to have a strong governance and consumer duty focused led due diligence process that they get help and support creating. It's not about saying, well, here's the product, here's the solution, you go away and do all the work and we'll just manage the money. They want to find firms that truly understand the risk and governance that's imposed on the advice firm and make sure that they provide that oversight, the audit trail, and the due diligence to enable the advisor to be able to take a step back. I'm not going to say relax, but I've just said it, and just enable the fund manager to deliver the outcomes that they want for their clients, but have the support and governance behind that, rather than just having a piece of paper that's sent through once a year to say our proposition's fit for purpose. And where there can be and where we can create efficiencies to make sure that we can help support the advice firm to reduce the administration burden, to enable them to concentrate on what they do best, which is look after their clients, and to help take some of those pressures working with too many platforms, too many tax wrappers, and charging structures that are complex and difficult to explain to the client if they were asked to demonstrate value. So what that led to was this roadmap. We have created 10 key steps that we feel that will support advisor firms that are looking to make that move from MPS to TPS, to give you an opportunity to sit down, take a step back, and we'd be more than happy to work with you on this on a face-to-face meeting if required. But I'll talk to you what this actually looks like at the end. To really sit down and ask yourself the questions: is my CIP and CRP fit for purpose? Does it have the capability to remain future-proofed in today's challenging regulatory strong market? Does it meet my brand values and what I'm trying to achieve? Does it represent the things that I want my clients to think about when they're looking at my business from an investment proposition? Can I find someone that can help me create this proposition and help support me through this journey? I'm not going to go through these 10 steps now. Each one of those is designed to take you through a simplified, structured, robust process that enables you to really define what your investment proposition should look like moving forward, and also puts into a situation where you can ask some very difficult questions to the providers that you're currently working with to understand whether they're meeting what you want rather than you're meeting what they want. So we're going to have a bit of fun now, as Jordan said at the introduction of this webinar. We are going to have a poll. What I'd like you to do is I'd like you to select the three most important areas that you would like me to focus on, taking a bit of a risk here on the basis that you get to choose those three areas. So if you choose between 1 and 10, the three most important areas that you want me to concentrate on, and I'll dig in a little bit deeper. I'm also going to pick one myself, because why shouldn't I? Just so I think it's important for us to take you through a process that enables you to understand the detail that sits behind this roadmap. So hopefully you should be seeing the Beyond Big Tech 10 steps. If you could kindly select the three most important areas, and I'm going to pick one as well. So I'm going to give you a little bit of time. Take your time. There's no rush. Just have a read. Find out the three areas that you feel are most important to you and your business, or the areas that you're generally interested in that you'd like me to just talk a little bit more about. When we did the 8 reasons why presentation, we did actually go through each individual 8 reasons why. We didn't get any feedback to say that advisors thought that was overkill, but I thought rather than cover all 10, we've only got an hour, let's just cover the ones that are most important. So I'm hoping that you have now selected your three most important. So 1, 2, and 3, select those, and fingers crossed, I'm going to move on to the roadmap. So, okay, I'm just waiting for heads up. Yep, okay, fine. Yeah, they're all in. Brilliant. So you've selected your three, I've selected my one. So, oh, interesting. Let's see what came first. Okay, number 2. This is in no particular order, by the way. So this is not the most popular downwards. This is just a random selection based on what you've chosen. That you'd like me to talk a little bit more about. So identifying pain points. Thank you for those that selected roadmap 2. This is a really, really strong one. So what the way that I'd like to talk to you about pain points is we think it's really important to sit down with firms and say to them, look, rather than just sit here and tell you about what a fantastic proposition we've got, how great Blackfinch are, the typical design of how asset manager businesses talk about their proposition. Tell us what really, really, really does pain you from a business running perspective, or a CIP perspective. Sit down and really understand the areas that cause you pain as a firm. Tell us and talk to us about what are the areas that really, really do stress you out. I've got some examples of some of the areas that other advice firms have spoken to us about relative to pain points. But what are the points that, if you could find ways to improve to make your business more efficient, where would those points actually be? So current range of portfolios, for example, do the model portfolios that you're currently using fit exactly what you're trying to achieve from an investment journey perspective? Where are you struggling with governance, due diligence, and oversight? How many platforms do you actually work with? Do you have too many? Do you have too many models? A live example of that, my own personal IFA, I hope he's not on the call because he'll probably tell me off. Brilliant firm, really strong business. They provide a completely flexible, buy what you want investment CIP framework. They're on 20 odd models, platforms. The range of solutions that are available are forever extensive, and there's a huge administration team. So him and I are talking about how we can find ways to create efficiencies within his business, to take that process down, to make it more manageable, create those operational workflows that enable you to be able to deliver good client outcomes, take some of that pressure, helping you evidence value for money, truly understanding what value for money represents, and it's not just cheap. Looking at areas that within operational frameworks that you might be finding complex or um, administratively burdeningly heavy. Trying to find ways to identify those pain points. Um, where do you spend the most time and where does it annoy you the most? Looking for ways that you can understand what really, really impacts your business negatively and finding ways that you can help uncover and create efficiencies to make those things better. Let's get back to the roadmap. Where did you go next? Oh, okay. So determining what to tailor, step four. Okay, this was something I spoke about earlier. I want to make it really, really clear. This is not tailoring is not to make it more complex. It's to try and make it more standardized, um, to create something that represents your values as a firm, but doesn't create operational complexities like you would have with a full bespoke service. Um, Within a tailored portfolio service, you really do have the flexibility to tailor any part of that journey. You can tailor all of it or none of it. It doesn't really matter. The choice is yours. It's thinking about what range of models do I really, really want? If I could pick the best range of all the MPSs or all the multi-asset funds and create a range of portfolios that take the best parts of all of that asset allocation fund selection, but I get the best outcome by taking the best the best range of models that I could possibly create. Do I want to create an accumulation service with a decumulation service? Do I want active versus passive? Do I want full passive? Do I want a blend approach? It doesn't really matter. The beauty of tailoring is you have the ability to be able to build any range of models within reason, um, and create something that is truly, truly tailored in line and difficult to replicate. It isn't something that other advice firms in the marketplace can copy because it's unique to you as a firm. Thinking about rebalancing, do you want a DFM service that has the capability to rebalance when it's right for the client and right for the market, rather than having a predetermined date, monthly, quarterly, set dates? Well, why should you have set dates? Why shouldn't you have a service that enables you to be able to choose, enables you to be able to work with your investment partner as to when you choose to rebalance, or when we work with you to make sure that we provide you with the information you're looking for, or you need relative to individual client circumstances. Thinking about reporting, what reports do you actually want? What do you need to make sure you have to tick your own internal box, but make sure you're ticking the the regulatory box, ensuring that your branding, client communications fit in line with exactly what you're trying to achieve. The whole point of tailoring is it enables you to be able to decide what you want to tailor rather than have to have a tailored solution. Think about the provider you want to work with and making sure they're creating the outcomes you're trying to achieve. So moving on, you chose five. So assessing cost and value. Again, a very, very popular topic. Thank you very much for selecting that. So as you know, Consumer Duty has created this increased scrutiny around costs, making sure that you can understand the layer of cost that sits behind any service you're using. Advice fee, platform fee, ongoing fees, AMC, fund underlying fund costs, transaction costs, a topic that Gareth knows is very close to my heart. Making sure that you fully understand and you can map out that fair value evidence to ensure that when the regulator, if they were to come and knock in, would not be able to question whether you had, 50 different solutions with 50 different cost structures that you have to have tested and proven fair value in line with your client segmentation. Why do that? Why need that range? A combined range of portfolios can achieve that for you without having to have multiple solutions and making it complex for you to identify and clearly explain the true cost your client's paying today. So my one, I chose number nine actually. So selecting a partner to and completing your due diligence. So how do you choose the right partner to work with? How do you look for key areas that you want the partner to prove that they can be genuinely strategic in your relationship? So all of the things I talked about earlier, it's about thinking about demonstrate to me, Mr. Partner. So I'm the IFA. Explain your investment philosophy, simplify the process, What research are you going to do? How are you going to help me to support governance and due diligence? How are you going to help me create an operational framework that creates efficiencies within my business? How are you going to make sure that my portfolios and investment proposition, both from investment and retirement, are fit for purpose? How are you going to adapt and evolve as the market changes? What are you going to do to help me create the best possible outcomes for my clients and demonstrating that the value of our relationship is built on us understanding what we're trying to achieve together rather than you just being given another service off the shelf. Hence, the introduction of the advisor playbook. This has been put together to create a structured 10-step framework. Everything I've just talked about is incorporated in this document in detail. It's a guide to help advisors that want to review their current proposition, are ready to move into a TPS framework. It gives practical examples, questions to ask yourselves and to ask your firms, and also to ask partners. It helps you talk about governance and risk, consumer duty focus. It basically helps you to ask the questions that you should demand upon the potential investment partner you're considering working with. It helps you to understand the process to transition from an MPS to a TPS. And it also gives you guides on how you can check in to make sure that you're following a process that is robust, easy to monitor, easy to implement, and ultimately allows you to create a very strong investment proposition, both from an investment and retirement, for now, fit for purpose and ready to take forward for you and your clients for the future to give you the best possible investment outcomes. Thank you very much for listening to me this morning. I'm really pleased to pass on to our head of multi-asset, Gareth Deacon, who will be taking you through Beyond Big Tech, exploring hidden concentration risks.
Great. Thanks, Mark. And thanks everyone for joining us today. As Mark just said, today I'm going to be talking about concentration risk and really the heading of this webinar that we're presenting today, this Beyond Big Tech, and where there may be other concentration risks that it's worth focusing some attention on. Now, concentration risk has obviously been a common theme for investor conversations over the last year. Concentration levels within major stock markets have risen, and concern has grown really about whether this brings a level of unintended risk to portfolios and to investors. So let's just talk about some stats to start with. Let's look at the lay of the land. Now, some of you may have heard some of these recently. But please humour me as I go through some of the reasons that advisors we're speaking to are considering the risks that over concentration may be bringing to their clients. Now, as I go through this slide, see if you can work out what it is I'm referring to. If we were all sat in the same room, I'd ask you to raise your hand when you think you know what I'm talking about. But given that I'm presenting this remotely today, I'll have to trust you to all be honest about the point at which you realise exactly what it is I'm referring to. So let's have a look at some of these stats. So this cohort have enjoyed market dominance over the last 3 to 5 years. The speed of their growth has left a lot of investors seemingly reluctant to look anywhere else. Thirdly, we've got the supremacy. Their supremacy rather has left the market highly concentrated, despite the number of other investment options there are available out there. Fourthly, that the return profiles, both positively and negatively, are driven by the same broad factors that leads to a high degree of correlation between them. And finally, these 7 names make up over 40% of their market. Now, again, I'm not going to be able to ask the question here, but I'm going to assume that most of you have reached the conclusion that I'm talking about the Magnificent Seven here. Well, in fact, that's not the case. All of these points I've just listed refer to another group of 7, which for the purposes of this presentation, I'm going to refer to as the MPS 7. Now, according to recent data from Next Wealth, and Mark said we obviously have a good relationship with Next Wealth. He was talking earlier about his conversations with Heather Hopkins. This is the top 7 AUM holders in the MPS market right now. While I won't be calling these out by name in this session, I'm sure that every advisor on this call could confidently name at least 5 of those 7, probably more. And what we've found from speaking to advisors is that when they're considering the composition of their CIP, they like to have perhaps 3, in some cases more, MPS providers as options on that CIP. And this could be alongside a multi-asset fund, perhaps a bespoke DFM, as they want to ensure they've got options for client segmentation, for clients in varying stages of wealth creation or in decumulation. When it comes to those MPS providers, what we're seeing is that advisors are gravitating towards the big players in the market. And we can see that from the statistic I quoted earlier. Despite there being over 200 MPS providers in the market, just 7 names control over 40% of the MPS AUM in the market today. And multiple of those providers appear on a lot of the CIPs that we're seeing from advisors. Now, as an aside, we run a CIP review service, which I'm sure Mark and Jordan would be delighted to talk to you about. If you want us to give you some sort of independent oversight of your CIP, that's something that we'd be more than happy to do. But why is this being ignored by the market? Why is concentration of stocks considered a big issue, but concentration of the MPS market is not being talked about? Now, anyone who's met me before or listened to me speak will know that I'm an absolute sucker for data. I love nothing more than crunching my way through levels and levels of data, looking for interesting themes that the market might be missing, and considering how these might be impacting on advisors and their clients. So today I'm going to talk you through some of the points that I found when I was digging through some of that data that may lead you to question whether the MPS 7 are really providing the best for you and your clients, and whether having more than one of these providers on your CIP is giving you the options that you need for client segmentation. Let's start with portfolio management and what we believe to be the 3 levers that the multi-asset portfolio managers have to enable them to drive returns for investors. Starting at the top, we've got asset allocation. In all cases, this will be a key driver of returns, right? Selecting how portfolios should be allocated between asset classes and geographies. And next up, that leads into tactical tilts. This is where the portfolio manager will shift from that long-term asset allocation, typically taking shorter-term positioning to produce returns or protect on the downside. And then thirdly, we've got fund selection. What investments will the manager select in order to populate that asset allocation? Now, these are not only the levers that a manager has to drive returns, they're also the key elements of their investment process that will differentiate them from other providers, that will provide you with, as financial advisors, with options when selecting portfolios for your clients. But only if a portfolio manager has the freedom and flexibility, and perhaps more importantly, the impetus and the rationale to use each one of these to their full extent. So let's start with asset allocation. Now, from data we've been able to extract from De facto, we can see on the screen here the headline asset allocation positioning of each of the MPS 7's risk level 5 portfolios. Their balanced portfolio on a risk level 1 to 10 scale, the one that sits right in the middle. Now, this data is as at the end of January. Now, on the face of things, I'm not going to ask you to go through this sort of forensically and look at every point of data, but you can see there's some key similarities, but it also appears as though there's some key differences. So let's zoom in on just the equity portion of that and pull that out and just see how similar or different those may be. Now, on this slide, we can see the allocations to the major equity regions. From left to right, we've got UK, Europe, North America, Pacific ex-Japan, Japan, and then emerging markets. Now, you will see a high degree of commonality here with allocations to regions like Europe, Japan, emerging markets, all looking broadly similar. North America, as we would always expect, provides the largest allocation across all portfolios. And it's perhaps the UK is the standout region which offers some difference of opinions, with some providers allocating over 30% of their equity bucket to the UK, while others are less than 5%. Now, while these allocations look like they have key differences, what happens if we actually plot the performance of each of these allocations over time? Now, if we go back to the full asset allocation again, not just the equity portion, and we construct each of the asset allocations, each of these portfolios using indices and sector averages, and test just how correlated or uncorrelated they are in reality across a number of time periods. Now, when I built this process and ran the data initially, I expected there to be some commonality, but the results surprised me, and I think they will surprise you as well. And this is what we can see when we look at the next slide. Now, so this is a correlation matrix in terms of how you read this data. Basically, the cross section where the firm down the left-hand side and the firm across the top meet, that will show you the correlation of those two portfolios. This is constructed using allocations deployed through indices and passives. We'll come on to fund selection in a moment. And then back-tested those correlations over 3 time periods. The first number in each cell being 6-month correlation, the second 12-month, and the third 3 years. In terms of what the numbers represent, essentially a correlation of 1.00 is perfect correlation, and then it moves all the way down to 0, which would be uncorrelated, all the way to -1, which is perfect negative correlation. Now, to be clear, the correlation measures the linear relationship between the return series of two portfolios, whether they're moving positively or negatively at the same time. It doesn't necessarily mean they're moving by the same scale, just they're moving in the same direction at the same time. Now, to be fair, we expect a relatively high degree of commonality between risk level 5 portfolios. We don't expect to see numbers in the 50s or the 60s or anything that would be categorized as low correlation, but equally, Not seeing a single number on this table that is below 97% correlation was a bit of a surprise to me. Well, at the face value, the allocations may look to have differences. The overall asset allocation outputs lead to very similar numbers from a correlation perspective. So, as we've met advisors in the past who do so, you may be blending different MPS providers for your clients with the hope that you're providing diversification. You may find that actually when that diversification really counts in those times of market stress, when diversification is what you're looking for, it might not actually be there if you are blending together multiple of these providers. Now let's look briefly at how we construct our asset allocation. What you'll see on this slide is the output from our proprietary strategic asset allocation process. First off, I want to be very clear when I say this is our strategic asset. When I say our strategic asset allocation process is entirely proprietary in structure. While we use some third-party inputs, the way in which we manage the process, come to our decisions is our IP. It's not something that could be replicated. So as I said, we use the third-party inputs to leverage the scale and expertise of a large international investment bank from a capital market assumptions perspective. It also helps to ensure we're not at risk of marking our own homework. So with the independent inputs, we feed this through our in-house stochastic modeler, and that's the output of that is what you see on the screen here. 50,000 randomized portfolios generated by that model. This creates the efficient frontier, this being the line above which no combination of asset class inputs could provide a better return at each incremental level of risk. As a team, we can then overlay this with our requirements from a diversification perspective to ensure that we aren't succumbing to concentration risk of our own. And from here, we can look at the individual allocations to each of these portfolios and select the preferred strategic asset allocation for each portfolio that we manage. Another important element I'd like to mention here is that we operate this at a relatively high level, so as not to create an allocation that's entirely prescriptive or leads to high levels of portfolio turnover every time this process is run. We want to provide ourselves with an output that allows us flexibility to allow us to deploy our best investment thinking to populate the asset allocation in the most effective way as market conditions dictate. Speaking of which, this leads us on very smoothly to the next lever that multi-asset managers can use in order to generate returns, which is tactical tilts or tactical asset allocations, maybe known. Right, so we talked about asset allocation from a high level, but the next element is of the management portfolios is how we adjust that asset allocation over time as market conditions change so as to provide better return potential or protect portfolios on the downside. What we're seeing on the screen here is the way in which the asset allocations of those 7 major MPS providers have changed over a 9-month period. Again, we're looking at that risk level 5 portfolio. So a 9-month period from April 2025 to January 2026. Now, in our opinion, as an investment team, this period has been one that's been characterized by a significant amount of change. And I don't mean at a portfolio level, I mean at a global investment level. We've seen the ongoing evolution of the AI capex cycle, the re-emergence of emerging markets as a key driver of global returns, question marks over the US being a safe haven given the volatility of President Trump, spiraling levels of government debt across Western developed markets. All of these factors that in our view means it's been a pivotal period for asset allocators to reevaluate their positioning, and very importantly, an opportunity to pick up some excellent returns by rethinking exposures. Now, if we look down each column here, you'll see how the providers have altered their asset allocations over that period. I've highlighted anything that's an additional reduction of more than 2.5%. Obviously, an addition being in green and a reduction being in red. We've used 2.5% as we believe this is approximately the level at which an adjustment can actually have a meaningful impact on overall portfolio composition. If we look at that first column, the biggest move is a 4.8% reduction in developed Pacific ex-Japan equities, which on the face of things looks meaningful, but where did that allocation go? It went to emerging market equities, a sector with a very high degree of crossover with the developed Pacific. So this is potentially likely just a fund switch from a fund that characterizes itself as an Asian fund into one that characterizes itself as an EM fund. So potentially not a huge asset allocation decision. In the second column, we have an adjustment from global fixed income into gilts. Not really much else worth speaking about. And in the third column, we've got nothing at all that breaches that 2.5% limit. In the fourth column, we have a large increase in US exposure and a reduction in other. Appreciate not particularly insightful, that one. I grant you, unfortunately, this is the way the data source has characterized this. So potentially a meaningful shift there. Portfolio 5, just a deployment of some cash, and in 6, again, nothing meaningful at all. And in the final column, we have a firm who's actually shown some conviction, taking about 10% of their fixed income allocation and moving it into equities, with the bulk of that going into the US. Now, if I told you the only provider here showing any significant moves is the only one that provides portfolios that are 100% passive in structure, then moving their asset allocation like this is literally the only way they can express their investment views. They can't even participate in the third lever that we're going to talk about. So it makes sense they may be a little bit more active on their tactical asset allocation. If we flick to the next slide, we'll look at the same data for our risk level 5 portfolio. Now, this is our MPS. Obviously, we manage tailored portfolio ranges for a number of clients, so each will have their nuances dependent on the requirements of that advisor. But I thought I'd use our MPS here just as sort of baseline. Now, as you can see here, we've got a 2.5% move out of absolute return into global fixed income. So an actual asset class move there. We're not just reallocating from one area of fixed income to another. But the biggest changes you'll see that we've made have been on the equity front. Well, it's not color coded. We've got a 2% trim in the UK, a meaningful increase across Europe, and then a large cut to our US exposure, reallocating that to emerging markets where we believe there's been some significant opportunity for returns. And to other, which in this instance I can tell you what it was. Essentially, that was a move into thematic funds. We think thematics is in a real sweet spot in the market right now, and if you can select the right themes to invest in, you can pick up some excellent alpha opportunities. So while this is just a snapshot in time, we would not necessarily be turning over our portfolios at this rate every 9 months. We think that everything that's been going on in the world in that 9 month period warranted some sizable movements. I'll let you all come to your own conclusions as to whether you agree with that statement or not, but this is the way we've been viewing it. I'm not necessarily telling you here what to see. I'm just telling you where to look and come to your own conclusions from that perspective. If we move to the third lever, this is fund selection. Now, what we have showing on the screen here is data from Citywire's MPS Monitor. It shows the most widely held active funds in the MPS market. Now, we're not just talking about the big 7 MPS providers here. We're talking across a large proportion of the MPS market. Anyone who provides their data to Citywire on a quarterly basis for this data set, which does include all of those big 7. Now, one of the issues when running an MPS that's in the multiple billions is that you become rather limited on fund selection. The internal risk controls that you will see your investment universe shrink to those funds that have the capacity to deal with your capital flow. So what we're looking at here on this screen is not only the names of the top 30 funds held, but also the AUM of each of those funds. And as you can see, this fund is unsurprisingly dominated by large-scale funds, with the average AUM of those contained on this list being just over £2.25 billion. Now, naturally, we should conclude that these funds are being held because they're the best of the best. The AUM is a direct result of excellent, consistent performance. Everyone's holding these funds because they represent the best selections for their portfolios. So if we flick to the next slide, we can look at how each of these funds has performed on a quartile basis against their IA peer group. So in the first column that we've added here, we see the 1 year, and the second being the 3 year. So as I said, this is against their IA peer group and on a quartile ranking. And yes, we can see there's been some consistency. Some funds that have been consistently first quartile over both periods. Then there's actually quite a concerning amount of 3s and 4s in this table. In fact, just under half, 14 out of the 30, or third or fourth quartile over 1 year, and 11 of the 30 or third or fourth quartile over 3 years. So why are these funds being held? I can confidently tell you that we wouldn't be spending active budget on a fund that's consistently underperforming its peer group. We're in a cost-conscious market. We need to be eking out every last basis point of alpha that we can for each basis point of cost that we're allocating. Now, it's definitely not to say there are not good funds on this list. There absolutely are. In fact, I think there's 4 funds in particular on this list which are excellent. And how can I be sure of that? It's because 4 of the funds on this list appear on our internal accredited list from which we populate every portfolio that we manage. Let's have a look at those 4 in question. 4 funds across 4 different regions: Europe, emerging markets, Asia, and the US. We can see the fund size here as well, so all funds of meaningful size. And then we can see their quartile performance. Every single one of them is first quartile in its peer group over the last 12 months. 2 are also first quartile over 3 years. Now, granted, 2 of them are third quartile over 3 years, and we'll come on to talk about that in a moment, why that may be the case. But the other thing I just want to add to this column this table is a final column that shows you the size of those funds when we first added them to our accredited list. If you compare those numbers to the size of the funds now, you can see that in every case, the fund has grown meaningfully since we first selected it. In all but one case, it's more than doubled in size, and in one case, it's nearly trebled in size. Now, I do just want to point out, because otherwise my compliance department would would get me in a lot of trouble. This isn't a recommendation to invest in any of these funds. It's simply to demonstrate that of the 30 most widely held funds in the market, only 4 of them are funds that you would see in any Blackfinch managed portfolio. Now, I mentioned I would cover off the final point there, that point about the fact that 2 of those funds were third quartile over 3 years. That's where I want to introduce the final part of what I'm going to talk about today, which is a phenomenon that I want to refer to as the S curve for funds. Now, you might be familiar with the S curve for business life cycles that demonstrates over time a business will likely start with slow growth during infancy before hitting its stride as it enters expansion phase, then entering maturity, at which point growth slows again. Now, I believe this is a similar trend that can be witnessed within fund management and alpha generation tied closely to the psychology of performance. So let's look at how my hypothesis overlays the psychology of fund manager performance with the S curve. We'll replace infancy with nervousness. We'll replace expansion with freedom, and then maturity with fear or potentially overconfidence. Now, my theory posits that during the early days of a fund's launch, that the defining feature of a manager's management style is that of nervousness. The manager has been given the opportunity to launch a fund. This may be their first such opportunity in their career, and something they've been working towards for years, perhaps even decades. So if we get inside the head of that theoretical fund manager, how are they feeling? Well, initially, undoubtedly, they'll be excited, but it won't be long until that excitement turns to nerves. This is their big chance. This is what they've waited for. What do they absolutely have to make sure they don't do now? They have to make sure they don't mess it up. So what does that lead to? It leads to reduced confidence in their decisions, not wanting to take large positional bets, not wanting to drift too far from the benchmark or the peer group. They just want to settle themselves in. They haven't yet won over the trust and support of their employer or their sales team. They just want to guarantee the long-term sustainability of the fund. And I don't mean sustainability from an ESG perspective. I mean they want to ensure that they don't give anyone a reason to take this opportunity away from them. Now, this period may last only a few months. In some managers, it could last a year or two. But they want to get through those first few reporting periods without doing anything disastrously wrong. When their sales team first take the funds to market, they don't want to be any difficult questions from prospective investors. So now they've got their feet under the table. They've had a few good conversations with their boss. Everything's going smoothly. But the company have noticed you've been, a little bit cautious. That the business has faith in you. The reins are off. Go out there and show us what you can do. Give us something we can sell, something to get the attention of the market. That's when we move into the freedom territory. Now, this is where a manager grows in confidence. They feel they can deploy their strategy how they want to create a fund they always wanted to manage. Now, the guardrails are still in place. The risk committee is still monitoring the fund. This isn't a time for excess risk or betting the house on red or black. It's just the freedom to manage the fund how they want to make a name for themselves, to generate a buzz, to get the attention of the market, to give their sales team something to sell. So what do we see from a truly quality fund manager during this period? We see alpha. We see a manager's true personality, their true management style, their true skill. And if this is distributed correctly, we'll see inflow, maybe not straight away, but it will come if the manager is talented. And this helps to build confidence, to give the manager belief in what they're doing, to give the market belief they know what they're doing. Eyes turn on the fund and more money flows in. The manager is a success. Everyone's happy. Now, this again can take time. This phase could last a few years as more investors wait for those arbitrary track records that their investment process document tells them they have to wait for, all the time waiting and watching the manager be a success. So what happens next? The money continues to flow. The business is backing the fund. The AUM's grown, maybe £1 billion, maybe more. So why do we ever enter the third phase? Why do we tilt back to fear? Now, in my view, this comes down to one factor, which is protectionism. The manager's success, they've made it. What's the worst thing that could happen now? They could lose it all again. They could become the latest rock star fund manager who believed their own hype, who took their eye off the ball, who became overconfident, who became complacent. So what does the manager do? They slow down. They start to second guess their decisions. They start to convince themselves that as long as they don't mess it up, they've got an incredibly successful career ahead of themselves. Just hold on to this AUM they've built and everything will be rosy. So they start to watch the competition, to watch the benchmark. As long as they don't underperform, no one will have a reason to disinvest. And here is one of my favourite phrases comes to fruition, really. Success is the enemy of innovation. Now, you may be listening to this thinking, yeah, that all sounds great in theory. Surely that doesn't happen in reality, right? This is just some GCSE level psychology. And you might be right. Okay, my wife studied psychology at university. I didn't. But as I said earlier in this presentation, I'm a nerd when it comes to data. And perhaps we can add to that I'm a nerd when it comes to the psychology of performance. So let's have a look at a couple of examples. Let's start with a sterling corporate bond fund. Now, I'm not going to be naming these funds for obvious reasons here, but just this is data we've extracted from widely available funds in the market. So we've got sterling corporate bond performance. from launch up until the end of April. Let's start with that top chart. Looks a little bit like an S, doesn't it? What we're looking at here is a relative performance chart. The line at 0 represents the performance of the peer group, the fund's benchmark, and the red line is the relative performance over time. The steeper that line, the more alpha the manager is producing, and the shallower the line, the closer they are to tracking the benchmark. So this fund may just fit my theory. The pseudo psychology might not be spot on, right? But the output certainly seems to fit. So what do we do as fund selectors? We watch newly launched funds, we speak to fund managers, we look for inflection points, we look for indicators that suggest this manager might be about to move into that freedom phase. And then, if we're confident, we'll add that fund to our accredited list. And that's exactly where you can see the orange diamond on this line. When we first bought the fund, now we would only take a small position initially. We wouldn't put all our eggs in the manager's basket, but we believe the manager might be able to start to produce exactly what we're looking for as managers, which is alpha. So we invest. When the fund has a track record in this case of just over 2 years, of which the first 18 months was relatively pedestrian, as you can see here, and the fund was just under £300 million in size. Before any of those arbitrary numbers that a lot of investment process documents look for, maybe a 3-year track record, maybe 5 years, maybe £500 million AUM, as otherwise they'll own too much of the fund because they're running £10 billion. Now let's look at the bottom chart. This chart uses the exact same time period and tracks the fund's AUM. Unsurprisingly, it starts to grow. The manager's performing. The fund is getting attention. But from April 2025 onwards, the level of that alpha starts to reduce. Now, we've been tracking this. We're actually, trimming our position as we speak. The fund is now £1.6 billion in size. We've been monitoring it really closely, actively reviewing the sector to hunt out the next manager we believe can generate the sort of alpha that this one has. Now, one other key point to mention that might be a contributing factor to this, to the top section of that S-curve, is capacity. This is a really important factor for any actively managed fund, at which point does the fund manager believe the fund becomes too big for their investment process and becomes compromised. We need to ensure we understand this, the fund house makes the right decision in soft closing that fund when it gets to that size. Let's move on to another example. This one's perhaps even a little more extreme. Here we're looking at a developed market equity fund, which is why it's a little bit more spiky because obviously equity funds are that more volatile than fixed income funds. You can see from the top chart, the fund follows a similar S-curve in terms of alpha production. So we've run this chart all the way back to the point at which the current manager took over the strategy. Those early days were a little brutal, perhaps a little more volatile than we might expect, but clearly a manager that was finding their feet, restructuring the portfolio that they'd taken over. But then we see that tick up into alpha. Strong numbers against the peer group, strong numbers against the benchmark. But look at the bottom chart. I've laid this one out slightly differently as I think it makes the story all the more clear. What you're looking at on the bottom chart is net monthly flow into that fund. So any bar above the line is a positive inflow for the month and any bar below is net outflow. So what do we notice here? That there was barely any flow into this strategy at all during that period of impressive alpha generation. Then something happened and suddenly the fund takes in hundreds of millions of pounds. Why was no one buying this fund during the expansion phase? The numbers were off the chart, the alpha was there, but no one caught it. The money starts to flow in large scale and the alpha slows down almost immediately. So all those fund selectors who looked at the numbers, saw it tick past its 3-year track record, suddenly flowed in and the fund started to move sideways. The alpha they'd hoped they would be achieving from this manager wasn't there once the capital flow came in. Now, the fund hasn't been a bad fund, far from it. There have been periods where the line still moves in the right direction, but there's also been times where it's underperformed. But it's floated relatively close to that benchmark because that fund is now over £4 billion in size, and that manager and that fund house do not want to lose their AUM. Now, one other factor to point out with this fund was a masterstroke from the fund house. It happened in March 2022. They slashed the fee on the fund. The fund was less than £200 million in size at the time. They undercut the market after that period of strong performance. Another thing that clearly caught the attention of the market and the flow came in. But did that flow capture the alpha the fund manager had been producing for the previous 18 months? I think we can safely say no. Now, what you're probably looking for in this chart is the orange diamond, and wait for me to tell you that we bought the fund in October 2021, give myself a big pat on the back. Well, in truth, there's no orange diamond on this chart. We didn't buy this fund. Sometimes these things pass us by. The important thing for us in this instance is to understand it's okay to miss these things, but don't follow the herd if the investment case isn't there. So to conclude, I've talked about concentration risk. I've talked about the 7 big MPS providers out there who control 40% of the market, there or thereabouts. I've talked about the way, and perhaps there's some key differences between the way in which they approach portfolio management and the way that sorry, the way that we approach portfolio management, the way that some of these providers do, and obviously the way that a tailored portfolio can feed into that even more. I've then talked about my thoughts on the psychology of portfolio management, some of those factors that keep managers awake at night. And trust me, I've been in this industry for over 2 decades. I've felt every single one of those feelings I've discussed today. But I've also talked about capacity and the importance of as investment selectors to understand the implications of capacity, to understand there's a sweet spot of AUM for any fund or any portfolio, no matter its strategy, at which point beyond that scale the fund will not provide you with the returns that you hoped for. That something within the process has to be compromised in order to continue to build scale. The point at which forensic investors start to question whether following the herd is really the right thing to do, even if the fund house halves the fees. The point at which you hope that the manager and the fund house makes the right decision to soft close that fund to protect the incumbent investors, to make sure that their investment process isn't compromised in any way and doesn't take the approach of asset gathering at the expense of their investors. And after all of the things I've talked about today, it leaves me with one question. I hope it leaves you thinking the same thing. Why have we never seen an MPS provider soft close their proposition? And with that, I'll hand back to Mark.
Thank you, Gareth. Thank you very much. So, in summary, today's webinar incorporated the evolution of moving away from off-the-shelf MPS to a TPS. Excuse me. The introduction of the advisor playbook. Gareth demonstrated that the MPS 7 control the lion's share of AUM, but are you really creating a robust CI and RP that is truly diversified, or as Gareth said, are you following the herd? So the MPS 7, are you really getting diversification? Did you really think that you were, and are you? Do you need to, have a look, dig deep, and find out what's really going on behind the scenes? Or do you have time and capacity to actually do that? So I wanted to bring this last session to life and talk to you a little bit about some real clients. So on the next couple of slides, I've got some examples of some live clients that have actually made the decision to move away from various investment propositions into a tailored service. So this client one, this was a client that were managing their own portfolios. They made the decision to outsource, but wanted to retain a close connection to their DFM. They did have views on asset allocation, and they wanted that reflected in their range because they have been running models for a very, very long time. I think the business has actually been trading as an advice firm for probably 40, 50 years. So very well established advice practice. They wanted to be involved, but in a way that when we were making changes to the portfolios, they wanted us to be able to provide them with advance notice so they could review and understand why we were making changes to their underlying client portfolios, use it as an opportunity to maybe question or challenge our investment decisions, but ultimately just to be kept in the loop to ensure that before we made any changes that they were well aware of what we were doing so they could understand our ethos and rationale behind those investment decisions. So they wanted 5 total return portfolios, six portfolios, plus 1 income variant to meet their decumulation requirements. They did have a preference from an asset allocation perspective from running their own portfolios, US large cap, low exposure to Japan equities. They wanted the ability for us to keep them up to date and advise them in advance of any trading or changes we were making. And as you can see, they gave us quite a risk tight risk budget of 30 basis points to play with. And I'm really pleased to say that we were able to meet all of their requirements, understanding the relationship of what they wanted for both themselves and their clients, and create a range of portfolios that covered an accumulation and a decumulation variation, giving the advisor the ability to maintain that control without actually making the underlying investment decisions, keeping that relationship very clear between what the advisor does and what we do as part of a tailored portfolio service relationship. So our next case study is a slightly different approach. This firm was already outsourcing and using MPS, so they were already in that process of working with an investment partner that was providing a model portfolio service. But as they were growing, so this firm is a generational based firm where it's a mum and dad that's passing down to son. And that firm is growing at quite a rapid pace because the son is you know a young um, advisor who's looking to grow their business for the future. And he found out quite quickly as he became more in control of the firm that actually their current investment provider wasn't really delivering the level of service they want based on the requirements of that firm asking for a set level of AUM. And they were looking for something more. They were thinking about CRP. They didn't have a proposition in place. They didn't know what they wanted to do, but they knew they wanted to formalize something so that they had something that was documented and written down if the regulator was to come and knock in. But also, it was delivering an outcome that was specific in line with what they were looking to achieve and in line with what income they wanted to provide their clients. They were comfortable to completely outsource the entire investment proposition, asset allocation, fund selection. They were happy to delegate all of those responsibilities over to us. And they also wanted to ensure that they had control over the investment objectives to ensure that as they segment their clients, that the portfolios that they were offering were in line with both their advice and investment segmentation process. Hence, born was 5 total return portfolios and 3 income portfolios targeting yields of 3, 4, and 5% to meet their decumulation or income-driven client requirements. We had again a tight risk budget of 40 basis points. But we did have the flexibility. Now, I love this. Very quickly, because I know we need to finish. Imagine having a relationship with a DFM where you can sit down with that DFM on a quarterly or ongoing basis, and the DFM says to you, look, we want to be able to increase our risk budget because we think there's more of an opportunity to go active or reduce it based on more of an opportunity to go passive. We just want to make sure that before we make those changes, that's in line with your expectations and that your clients are happy and that you're happy. So we will sit down with the advisor and we will talk to them about what our rationale is. And if that results in us having to increase costs, we explain why we're doing it, and the advisor gets to have the choice and option as to whether they're happy to embrace that and make those changes. And I'm pleased to say that never have we had a situation where an advisor firm has not been happy with any increase in costs or decrease in costs relative to achieving the best possible outcomes for their clients. So I'm going to now pass over to Jordan, who will close today. And I'd just like to take this opportunity to thank you so much to every single one of you that's dialed into the webinar. I hope you've enjoyed it and got value out of today's session.
Thank you, Mark. And again, thank you everyone for joining us this morning. Also, we hope you found today's session useful and it's provided some practical ideas around portfolio construction, diversification, and obviously the role that a tailored proposition can play in improving client outcomes. Now, we'll be sending a feedback survey, and that'll be coming to you shortly. I would greatly appreciate your thoughts on today's session, and that'll come up automatically, so don't worry about closing the window. And once completed, I'll be following up with your CPD certificates and a copy of the playbook that Mark has mentioned. And of course, if you'd like to continue the conversation, explore any of the themes we've discussed today, or simply learn more about how other advice firms are approaching the transition from MPS to more tailored solutions, then do get in touch using the contact details we have on screen for you now, as we'd be delighted to hear from you. But for now, all that's left for me to say is thank you again for your time, and from all of us here at Blackfinch Group, we wish you all a very pleasant day and look forward to speaking with you again soon. Bye for now.